What's up, everyone? Back at you again. Today, I'm not going to be talking about cryptocurrency. I know that I established a channel and I primarily so far talked about crypto, but this channel is supposed to be giving investment tips and advice. I'm not a financial advisor, but if you want to learn how to make some passive income and you want to learn how to grow that nest egg, then this video is for you. So today, I'm going to be talking about dividend stocks, but I want to break it down from a basic perspective. I want to break it down as if you do not know what a share or how to invest, what a brokerage is, right? So what is a brokerage? Well, that's a company like Robinhood, Charles Schwab, E-Trade. Anybody can go onto one of these companies, look up their website, and you can open an account. Some of them, they require a certain amount to put in to establish that account, but most of them are pretty easy, something like Robinhood. So if you go into Robinhood and you try to buy a share of a company, so say I want to buy a market order of, say, McDonald's. I want to buy one share of McDonald's. That means that I own a fraction of that company. I am a part owner of McDonald's. So now we have dividends. What are dividends? So a dividend is a yield from the company that is given to common shareholders because of the excess cash that they have on hand. So after that year or throughout that year, when that company has an excess amount of cash, that means that they are profitable. So they can say, well, what are we going to do with this excess money? Do they have to pay it to the shareholders? No, they don't. They can put it into R&D, research and development. I can say, hey, I want to make sure my company can grow and expand. I want to put this money into development. Let's not give it to the shareholders. Or I can give a certain percentage back to the shareholders because the board of directors for that company has chosen to do so. So a lot of people talk about dividend stocks. Why is that? Why are dividend stocks important? Dividend stocks are a form of passive income. That's why they're important. So I had pulled up NLY, which is Annaly Capital Management. Annaly Capital Management, which you can see on the screen now, I'm on Yahoo Finance, is a REIT. A REIT. A REIT means a real estate investment trust company, which primarily deals with real estate. REITs are important because they're known to give one of the highest dividend yields per share to the common shareholders. And I want to pull up something, and I'm going to show you why. So REIT dividends are substantial because they are required to distribute at least 90% of their taxable income to their shareholders annually. Their dividends are fueled by the stable stream of contractual rents paid by tenants of their properties. So 90%. Does that mean REITs are the best? No, not necessarily, right? Because, some companies fail. So some companies do not grow. They're not profitable. They're either undervalued, overvalued. So dividends are not the be-all for a company. I actually want to let you know that if you look up how much a company pays in a dividend, say it's around 20%, and you're like, wow, that's such a high amount. I'm going to get all these dividends for this really low company, this low price per share. That's a red flag. Does that mean that they're necessarily a bad company? Probably not. But it doesn't mean that they can't slash that dividend or take away those dividends in whole. Right? So a company can change their dividend anytime they choose. They can increase it, they can decrease it, they can take it away, they can choose to have a dividend. And what's important to look at when you pull up something like this, what's on the screen, the Annaly Capital Management, you look at your forward dividend and yield. So this says 88 cent, 9.53%. That means that this company, and I know this because they don't all pay quarterly, but this company pays quarterly dividends of 22 cents, which is 88 cents per share of NLY per year. So per share is 88 cents per year. Some companies, they pay monthly, they pay weekly, they pay yearly, they pay whenever they feel like it. So it's imperative that you look up these companies, go on their websites, look up their investor relations, look at their, price to earning ratio, understand what an earnings per share is, because you want to understand if this company is doing well. Is it profitable? Is it going to grow and expand? Do they have a strong team? Just because they have a high dividend does not make them a great company, right? Like I said. So if you look at NLY, we look down here on the 52-week range. They were $6.12 at the low. Their high was $9.35. And right now they're hovering right around $9.20, 19 cents. So that means that this company has grown has grown, excuse me, over the course of the year. So that's a decent company. If a company is going down over time, they're not doing so well, that's just decreasing the amount of money you're getting. So your dividends are not really making up for that, or they're barely making up for that. So let's look at another example. So we have Pepsico. Pepsico, of course, is not a REIT. It's a company that's been around for a very very long time. But when we look at this one, we have $148.30 per share. So a lot more expensive than $9.19. But you can see that the forward dividend and yield is much higher. I'm getting $4.30, which is 2.90 per year. So that means that every share of Pepsi, I have $4.30. Is this necessarily better? No, but I mean, you want to diversify, right? So maybe it's good to have some Pepsi in your portfolio, and you also have some NLY. So if NLY is not doing so good, and Pepsi is, you can offset and you can hedge against that. So, all right. So something else I want to show you, right? We're going to break it down. So you have active and passive income. Active income, I go to work every single day. I do manual labor, and I get a paycheck. If I want passive income, when rich people talk about, staying rich, it's because they have a bunch of different revenue streams. I have a bunch of different passive income. I can go to sleep and I can make money as I sleep. And it can be in the form of stocks. It can be in the form of cryptocurrency. It can be in the form of decentralized finance in the crypto world. But another one is dividends, right? Because as long as this company is paying me 88 cents per share per year, I know that I'm going to receive that income as long as they're paying it. So let's break down an example, right? So if NLY is $9.19 per share, and I want to build up to 200 shares, that means the total cost is going to cost me $1,838. Not too bad. I can do this over time. Okay, but how much is this going to pay me in dividends, right? So I have 200 shares. So 200 shares times 88 cents. I'm going to receive $176 per year of passive income in just dividends, just for buying this stock. So say I have 200 shares of a company that does not pay me a dividend. That means unless they're growing, I am not making extra money. But if I have 200 shares of this company, I'm making an additional $176 per year. This is important because the more you diversify your dividend stocks and the more that you buy, the more that your passive dividend income is going to increase. So when people out there talk about, I want to get to 1,000, 5,000, 10,000, 50, 100,000 per year in dividends and passive income, that really means they're getting $100,000 in dividend income per year. And you can have that dividend income paid directly to you, or you can reinvest it. So all of these brokerage accounts have what's called a dividend reinvestment program, which is called DRIP, D-R-I-P. And they can automatically reinvest those dividends back into that share, back into that company. So excuse me, not the share, but back into the company, and you can grow those shares that you have. So it's just compounding. It's growing and growing and snowballing over time, and you're earning more and more. So take that into consideration. But do keep in mind there are tax considerations for your dividends. You have to look at if it's a qualified dividend, how long you've had it. Most times, if you've had it for at least 60 days, then you're going to pay substantially less taxes on it. So you also want to look at the ex-dividend date. An ex-dividend date means that this is the date that you have to have bought this share in order to qualify to receive the dividend. If you buy that share on or after that ex-dividend date, then you will not be qualified for that dividend. So I hope that this video was very helpful. I hope that you got something from it. I really didn't have a mentor growing up, and if you want to reach out to me and you want to ask any questions, I'll be more than happy to reach back out to you and help you out. So please like, subscribe, hit that notification bell. YouTube, the algorithm, they'll bring up more videos like this. If you do that, subscribe, and see y'all later. See you in the next video.